we're looking at a massive beat against prior internal guidance this quarter. Bausch Lomb, ticker BLCO, just reported Q2 2026 revenue of $1.394 billion.
Right.
I mean, that is a 9% increase. And adjusted EPS came in at 15 cents, while GAAP EPS showed a loss of 4 cents. And management, they didn't hesitate.
No, not at all.
They instantly followed this earnings print by raising full-year 2026 guidance. Revenue is being bumped up to between $5.440 billion and $5.540 billion.
Yeah, huge numbers.
Exactly. And adjusted EBITDA is raised to $1.025 billion to $1.0075 billion. The stock is reacting aggressively because, the market is digesting a report that fundamentally alters the forward-looking trajectory of the company.
It really is a phenomenal quarter if you're looking for execution on a long-term strategy. I mean, to frame these numbers through management's lens, just look at what CEO Brent Saunders stated directly in the release.
Right. What did he highlight?
He pointed to 4 specific pillars: broad-based revenue growth, leverage in the P&L, margin expansion, and conversion to cash flow.
Hitting all the right notes for Wall Street.
Exactly. What this report confirms is that the company's 3-year strategic plan is, it's not just on track, it is actively accelerating.
Yeah, and for you listening, whether you're modeling this out for your portfolio or just trying to understand the mechanics of a massive healthcare business, our mission in this deep dive is to figure out exactly how they pulled this off.
Right. The how is the interesting part.
Because to understand that raised full-year guidance, we have to look way past the top-line beat. We need to dig into the underlying segment performance that actually drove this margin expansion.
Yes.
It's basically a story of how a seemingly boring, predictable contact lens business is secretly funding a high-risk, high-reward medical device revolution.
That is the perfect way to frame it, honestly, because when you look at the standout segment this quarter, it's surgical. They posted $256 million in revenue.
Which is what, a 19% increase?
Yeah, a 19% increase. And in a mature medical device and eye health market, a 19% divisional jump in a single quarter is incredibly aggressive.
It's massive. But where exactly is that 19% coming from? I mean, they aren't just suddenly doing 19% more cataract surgeries across the globe, right?
No, they aren't. And that's why you have to isolate the specific driver within that surgical segment to see why it matters. The engine here was the implantables division.
Okay.
They reported a staggering 175% reported revenue growth in premium intraocular lenses, or IOLs.
Wow. Okay, let's pause and make sure we define what an IOL actually is, because intraocular lens sounds like something out of a sci-fi movie.
It does, yeah.
When someone gets cataract surgery, the natural cloudy lens of their eye is removed and replaced with an artificial one that's the IOL.
Right.
A standard one just clears up the cloudiness. But a premium IOL, that can correct astigmatism or give you multifocal vision so you don't even need reading glasses anymore.
Exactly. And what's crucial for you to understand as an investor isn't just the raw 175% growth number, it's the structural shift it represents for the company's unit economics.
Right.
This premium portfolio now accounts for 13% of total surgical revenue. If you look back at 2025, it was sitting at just 6%.
Let's unpack this with an analogy, because this shift from 6% to 13% in 1 year is wild.
It really is.
This is essentially like an automaker that typically sells reliable, mid-tier sedans, suddenly selling 3 times as many of its highest-end, fully loaded luxury models.
Yes.
The overall volume of cars sold, or in this case, surgeries performed, might only go up a little bit. But the profit they make per unit absolutely skyrockets because they're selling a top-tier product. So is this massive shift in product mix the primary reason we saw adjusted gross margin expand by 160 basis points to 62.2%?
It is the driving force, yes. When you transition your revenue base toward premium implantables, you fundamentally alter the profitability of the entire segment.
Right.
Let's translate those basis points into real impact. For every $100 Bausch Lomb brings in, they are keeping an extra $1.60 in pure profit compared to last year.
That's huge.
Yeah, those higher margin items drop straight through the income statement to the bottom line.
And when you're dealing with billions of dollars in revenue, an extra $1.60 on every $100 is a mountain of cash.
It is. And that margin expansion directly translated to real-world cash generation. This is the metric that should jump off the page for anyone analyzing this report.
The cash flow.
Exactly. Cash flow from operations skyrocketed from $35 million in Q2 of 2025 to $153 million this quarter.
Oh, wow.
Yeah. That is a $118 million favorable swing year over year.
That is operational leverage in its purest form. You scale revenue by 9%, but the actual cash flow from operations multiplies more than 4 times over. You do not see that every day.
You really don't. They are keeping significantly more of every single dollar they bring in. But here is where we need to look at the whole board.
Right.
Because while surgical provided this explosive margin growth and all the exciting headline numbers we just talked about, you cannot run a $5.5 billion company on premium cataract lenses alone.
No, definitely not.
Which brings us to the actual high-volume engines of this business, pharmaceuticals and vision care.
Right, because someone only gets cataract surgery once, maybe twice in their life. You need recurring revenue.
Exactly.
Let's look at the pharma segment first. They brought in $354 million, which is up 15%. And the data shows this growth was heavily concentrated in their branded dry eye treatments.
Yeah, the dry eye space is interesting.
Specifically, Amiibo was up 44%, and HEYDA was up 6%. When you combine those two, they delivered 27% growth in the first half of 2026.
The dry eye market is notoriously difficult. It's a chronic condition. It disproportionately affects an aging population. And finding a drop that actually provides relief without just washing away in 3 minutes is really tough.
Right.
But when you have branded pharmaceuticals like Mibo and Eboi gaining that kind of traction, it creates an incredibly sticky revenue stream.
Because once a patient finds relief, they aren't going to suddenly switch to a cheaper generic just to save a few bucks. The switching cost is their own physical comfort.
Exactly. And Ebo alone jumping 44% shows that their market penetration strategy, getting these specific drops into the hands of optometrists and ophthalmologists who then prescribe them to patients, it's yielding massive returns.
Okay, so that's the prescription side. But then we have to look at the absolute largest segment by sheer volume, which is vision care.
Right.
They came in at $784 million, up 4%. And the report highlights broad-based contact lens growth across the board. We're talking daily SiHy up 16%, BioTrue 1-Day up 13%, and the UltiRA monthly lenses up 9%.
And just to clarify for those not deep in the optometry world, SiHy stands for silicone hydrogel.
Okay.
It's basically the gold standard material for contact lenses right now because it allows much more oxygen to pass through to the cornea. It's all about breathability and comfort for daily wear.
Right. And alongside those contact lenses, they had a very successful consumer launch of Blink Triple Care Preservative Free, which drove 12% reported revenue growth for the entire Blink franchise.
Yeah, solid numbers.
So they have their contact lenses, their saline solutions, and they note their AREDS3 eye vitamins are now in over 25,000 retail stores in addition to Amazon. I mean, it's a massive consumer footprint.
It's all about volume and consistency.
But wait, I have to challenge this narrative a bit.
Sure.
I'm looking at these numbers. The overall company is growing at 9%. The surgical segment jumped 19%, pharma jumped 15%, and then you have vision care, the biggest chunk of the business, sitting there at 4% growth.
Great.
Doesn't that act as a drag on the stock?
Mm-hmm.
If I'm an investor, aren't I looking at that $784 million growing at a measly 4% and thinking it's just dead weight pulling down the overall growth multiples?
I can completely see why you'd look at a 4% number next to a 19% number and think it's dead weight. But you're looking at it backward. Yeah, that 4% is arguably the most important number in the entire report. You have to look at vision care as the anchor segment of the entire enterprise.
How so? Walk me through that.
Think about the mechanics of consumer eye care. It operates almost exactly like a subscription model.
Right. Okay.
When a consumer finds a contact lens that doesn't irritate their eyes, or a lens solution that works for them, they do not switch. They buy it every month or every quarter like clockwork for years.
Yeah, the hassle of going back to the eye doctor to get fitted for a new brand just isn't worth it.
Exactly. So that 4% growth isn't a failure to capture market share. It's 4% growth on top of a massive, rock-solid base of $784 million.
Got it.
The steady, predictable cash flow generated from those consumer contact lenses and over-the-counter products is the lifeblood of the company. It is exactly what allows Bausch Lomb to fund the intensive, expensive clinical trials we see in the pharma and surgical segments.
Ah, I see. So without the boring contact lens solution being sold at pharmacies every single day, they literally couldn't afford to invent the premium cataract lenses that are driving the 19% growth and expanding the gross margins.
Precisely. That predictability is what gives the management team the financial runway to take high upside swings in medical devices and biotech. You need the utility-like cash flows to fund the biotech-like risks.
Okay, that makes perfect sense. The stable baseline funds the innovation. But let's talk about the reality of those biotech-like risks. because innovation doesn't always go perfectly according to plan.
No, definitely not.
I want to shift our focus from the trailing numbers we just discussed and look at the forward-looking risks and the pipeline updates management specifically flagged for investors in this report.
This is a critical pivot because the earnings beat is great, but the disclosures are where you find out what the company is actually worried about.
Exactly. Let's look at a highly specific R&D update from the report regarding the Invista Beyond Investigational IOL Pivotal Clinical Study.
Yes, the Invista Beyond.
So this is one of those premium lenses we were talking about earlier. The study was designed to provide cataract patients with an expanded range of functional vision. Now, the report states it successfully met several co-primary effectiveness endpoints for intermediate vision, and it showed superior depth of focus compared to a control lens.
Right.
But they explicitly noted narrowly missed predefined performance targets related to depth of focus and intermediate visual performance.
Right. And in the med tech space, a miss, no matter how small they claim it is incredibly notable.
But let's clarify what depth of focus actually means for a patient. I look at this clinical miss kind of like buying a pair of highly expensive progressive glasses.
Okay. Yeah.
The distance vision is perfect so you can drive, and the reading vision is perfect so you can see your phone. But the intermediate vision, say, looking at your computer screen on your desk, it's just slightly blurry. It's totally functional. But in a premium market where patients are paying thousands of dollars out of pocket, they expect absolute perfection.
That is a great analogy. And that expectation of perfection is exactly why a narrow miss is penalized heavily by the market.
Right.
In biotech and medtech, it doesn't matter if you throw a perfect spiral if the ball lands 1 yard short of the end zone. Missing a primary endpoint can impact your FDA labeling.
Oh, interesting.
Yeah, if your label doesn't explicitly say you hit that depth of focus target, your competitors will use that against you in the marketplace. It degrades your premium pricing power and slows down market adoption by surgeons. So a miss is a miss, and that future revenue risk has to be priced into any investor's model.
And what makes this miss particularly interesting to me is another line item in the report.
Mm-hmm.
Overall, adjusted R&D spending across the entire company was actually dialed back 19% to $114 million this quarter.
Yeah, I saw that.
Are they underinvesting in the pipeline just to juice their current margins?
That is the multi-million-dollar question. When you see R&D drop 19% down to $114 million, it can be interpreted in two ways. Optimistically, it's strategic rationalization. They are cutting the fat, abandoning trials that aren't showing promise, and focusing their capital only on their best assets.
And pessimistically?
Pessimistically, it's a warning sign of underinvestment. If you cut R&D to artificially inflate your operational cash flow for a few quarters, you're starving your future pipeline. And in the medical device sector, if you don't have new products launching 3, 5, 10 years down the line, you die.
But, looking closely at these disclosures, I almost feel like we are missing the forest for the trees by obsessing over a single clinical trial or the R&D budget.
How so?
Because when you read the broader macroeconomic risks they cite, it feels like the real threats to this company aren't in the laboratory. They are in the boardroom.
I completely agree with you. If you connect this earnings report to the bigger picture, the corporate overhangs are massive.
Right.
Buried right there in the risk disclosures is the ongoing, highly complex planned separation from Bausch Health Companies, or BHC.
Right. For context, Bausch Lomb is still dealing with the structural realities of a partial spinoff from their parent company, BHC. They aren't fully independent yet.
Exactly. And the disclosures reiterate a critical point. Completing this distribution, meaning making Bausch & Lomb a fully independent, publicly traded entity, is entirely reliant on achieving targeted debt leverage ratios.
Let's explain what that actually means mechanically. A debt leverage ratio is essentially a measurement of how much debt a company has compared to its earnings, right? It's EBITDA.
Right.
So what you're saying is they have to hit specific financial metrics and prove they aren't drowning in debt just to be allowed to execute the separation.
Yes. Think of it like a young adult trying to move out of their parents' basement. The bank isn't going to let them take on their own mortgage unless they can prove they have a steady income and manageable existing debts.
That makes sense.
Bausch & Lomb has to prove to the debt markets that it can stand on its own 2 feet.
And suddenly, that $153 million in operating cash flow we talked about in the very beginning takes on a whole new level of importance.
It is the golden key.
Right.
It's not just about showing Wall Street they are profitable. It's about actively de-leveraging the balance sheet to unlock their corporate independence.
Right.
Every extra dollar in cash flow helps them pay down debt or improve that leverage ratio. If they can't manage those debt covenants, the separation stalls, the parent company stays involved, and the structural overhang drags on the stock price.
And as if a complex corporate divorce wasn't enough to worry about, the disclosures also specifically cite new tax provision uncertainties stemming from the newly legislated One Big Beautiful Bill Act.
Yes. Now, without getting into the political debate surrounding the bill itself, because our job is just to look at the math, the reality is that new legislation often creates immense corporate confusion.
Because the tax code changes, and suddenly accountants aren't entirely sure how to classify certain deductions or international revenues.
Precisely. And markets absolutely hate uncertainty, especially when it comes to the tax line on a profit and loss statement.
Yeah, nobody likes tax surprises.
If analysts cannot accurately forecast what a company's effective tax rate is going to be because of this One Big Beautiful Bill Act, it throws off every single discounted cash flow model on Wall Street.
Right, because if you don't know how much of the profit the government is going to take, you don't know what the company's actually worth.
Exactly. So you combine the complexity of a corporate separation, which is entirely reliant on the whims of debt markets and leverage ratios, with brand new legislative tax impact.
That's a lot.
Those are the macro overhangs that keep institutional investors extremely cautious, regardless of how fast those premium IOLs are flying off the shelves.
Okay, we have covered an incredible amount of ground today. We started with massive beats and guidance raises.
We did.
We unpacked how surgical margin explosions driven by premium implantables are changing the unit economics. We explored how the reliable, subscription-like cash flows of daily contact lenses are funding the clinical trials. We analyzed the nuances of missing a depth-of-focus endpoint. And finally, we looked at the massive boardroom structural shifts and tax uncertainties hanging over the whole thing.
It's a deeply complex puzzle. The operating business is clearly executing, but the corporate structure is heavily burdened, which leaves you, the listener, with a final analytical question to mull over as you digest this report.
What's the puzzle?
If Bausch Lomb can expand gross margins by 160 basis points, generate a staggering $153 million in operating cash flow in a single quarter, and confidently raise full-year guidance, all while carrying the massive structural weight of the pending BHC separation and uncertain tax liabilities.
Yeah.
What is the true intrinsic value of this company once they finally achieve full independence and clean up their balance sheet?
That is the ultimate question. If they are performing this well with one hand tied behind their back, what happens when they are finally let off the leash? We'll be watching closely to find out. Make sure you follow the show and keep us in your feed for your daily earnings coverage.